Hi everyone, and welcome to our third quarter 2023 newsletter. It's been a tricky quarter for the SA markets, with the JSE ending down about 4% for the quarter. And in that context, I've been pleased with the performance of our high growth and pure hedge funds during both the quarter and for the year. We're currently sitting up high single digits in both mandates versus the market that's now actually marginally down for the year. The longer term performance of both mandates, both our funds also remain attractive. To start off with, on a positive note for South Africa, the load shedding situation has continued to improve as we had expected somewhat in our last quarterly interaction where we covered load shedding in great detail. The first of the 4 Kusile units that we were expecting to come back to the grid has actually done so about a month earlier than expectations, and this is a real big positive for SA because it means they are executing on bringing those units back, and it gives us great confidence that the remaining 3 will come back on plan in this last quarter. So it leads to 2 things. Firstly, there's more power available in the grids, leading to lower levels of load shedding, but also it allows Eskom to take more units off for planned maintenance and even unplanned maintenance to improve the stability of the grid for the months and years ahead. So overall, a nice little positive for SA that this is moving in the right direction finally after many difficult years. On the other hand, I think the picture for the government deficit has worsened. Tax collections has been running lower than expected this year, and it's something we were expecting due to the lower company profitability levels, and especially the resources sector, but really across the JSE. So we really think it's something the government and Treasury will have to focus on, and the likely outcome is that they're going to have to control expenditure to reduce deficit levels. If we then move on to global markets, there's been a very, very substantial increase in global bond yields during this quarter, which is a real major event for markets. And there's 2 main reasons why this is important. Bonds in the US and the UK and all over developed markets are an alternative to equities. And with US and UK long bond yields now at 5%, I think it provides a real alternative for pension funds versus these bonds trading at 1 or 2% a while ago. So that should mean a shift from equities to bonds, and all else equal, it typically means lower equity valuations. But the second most important reason why bond yields should cause caution is that higher interest rates have a negative impact on the economy over time. It takes a while to feed through, but it impacts consumer mortgages, it impacts vehicle loans, credit card loans, and then very significantly it also impacts corporate borrowings when they roll over their debt, and even the cost of government debt. So typically we've seen periods of high bond yields being followed by periods of lower economic growth, and that's currently what's making us somewhat cautious on markets. So what have we done in response to this? We've felt it's time to be much more cautious at a portfolio level, and we've therefore reduced overall equity exposures in the funds. At the same time, we've also bought protection for the first time in a few years. So we've got a meaningful tranche of protection in place that protects the funds if global markets sell off from current levels. I can tell you that at the same time, we are still looking for attractive bottom-up stock picking ideas that should provide returns to the funds regardless of the overall economy, leaving us in a position where if markets do recover or do run from these levels, we should participate to a meaningful degree. However, we feel it's an environment where you'd rather want to be positioned to take advantage of weaker markets. So we are sitting with excess cash that we're looking to deploy into any potential market drawdown we might see. So in the rest of the newsletter, we're going to cover a few times where Peregrine Capital's been in the media in the last months with various thought leadership pieces, and you'll see a few of our other videos as well. So to end, I just want to wish you well for the end of 2023 and the fourth quarter, and I hope you and your families have a great and safe festive season.